Okay, in this video we're going to talk about transactions and how to record these transactions using the accounting equation. Now, this is to help us get started before we do journal entries with debits and credits. But first, let's talk about what assets are. This is anything a business owns that will benefit them for more than one period. So think of assets as anything that's going to benefit a company for more than one period. And then liabilities are anything that is owed, and normally we say to creditors. So going back up to assets, think about assets, the purchase of equipment. This equipment is going to be used for more than one period, more than one accounting period, so we like to record this as an asset. But if we were to purchase, if we were to purchase gasoline, that would be an expense because we're going to use it up quickly in less than a year. So assets are more than a year. And then owner's equity, if you look at your accounting equation, assets equal liability plus owner's equity. If we were to move this around and say that assets minus liabilities equal owner's equity, basically that means that everything you own after you pay off your debts is what the owner has in equity. What's left when the liabilities are paid off, what's left over. Okay, now let's look at our different accounts. So cash, that's normally what you think about, the amount that you have in your bank account or any cash that the company has. Office supplies could be paper, pens, anything used in office, land. Then you have accounts payable. This is your liability. Anything that's ending in the words payable is a liability. Capital, this is any owner's investment. So if an owner takes cash or donates land to the company, this would be recorded in the capital account. Drawing, if the owner withdraws any cash, this would be in drawing. Fees earned is the name of the revenue account. And there are other revenue terms for revenue that we'll go over later, and I'll help you learn those. And then all of these expenses that we have in this problem. Now let's talk about the components of. So for the components, I've already typed them out over here, so I'm just going to go over them with you. Capital will increase owner's equity, and drawing will decrease owner's equity. And then you have fees earned. Any revenue is going to increase owner's equity, and expenses are going to decrease owner's equity. So as we enter them up here, if it's a decrease, we're going to put a minus sign. Sometimes in accounting, instead of minus, you'll see parentheses, but those mean the same. So let's go ahead and get started with our transactions. Okay, so for letter A, Chris Clark deposited $25,000. He is depositing $25,000 into the Chris Clark business. So what that means is cash is increasing by $25,000. Anytime an owner invests anything into the business, the owner's capital account will increase as well. Now, notice that the equation is balanced because we increased on the left side and we increased on the right side. So the equation is still balanced on both sides. For the next transaction, Net Solutions paid $20,000 for the purchase of land as a future business site. So we are paying, the company is paying $20,000 for land. So cash is going down by $20,000 and land is increasing by $20,000. So if you notice, the net effect of this transaction is 0. So we have an overall effect. This side, nothing was affected, so we end up having 0 on both sides. So now what we're going to do, basically the owner's equity is not changing because we're trading one asset for another. One asset's going down, one asset is going up by the same amount. So now let's get the net effect here of this, and then we'll just copy this all the way over, and all of these accounts have 0 balances, and we do not need to copy it over where I have my plus sign. I just like to put that there so you can see what's being added and what's being subtracted onto each side. It's not necessary that you have that in between. It probably makes it a little bit harder to copy your formula across. So for C, Net Solution purchased supplies for $13.50 and agreed to pay suppliers in the near future. So Net Solution is purchasing supplies. Well, how do they purchase those supplies? They have to use cash. If it says in their near future, that means they're not using cash. So what's going to happen? They're going to charge it. It's going to be a liability. Liabilities are going to increase because they owe it. So let's record the $13.50 of supplies, and accounts payable, the liability, what we owe, is actually increasing. So notice that the asset side increased and the liability side increased. So our balance stays the same. So I'm going to add these up, and I'm going to do this with the rest of the formulas. So give me just a second. I'm going to pause the video. Okay, another thing to point out, when you record a liability, think about when you charge your credit card. When you charge your credit card, your balance goes up. Your liability goes up. But then when you pay some of that balance off with cash, your balance will go down. That's kind of what liability is. Let's look at the next one for D. Net Solutions received cash of $7,500 for providing services to customers. So we know that we are receiving cash, and cash is increasing by $7,500. So we know that that is going to make our cash account go up. And then I'm going to go ahead and bring these down. And I'm just going to copy the number, bring the balance down if it's not being affected. But when we perform a service, we have to record revenue. This is fees that we have earned because we have performed the service. So we, let's see, $7,500 is what we're going to record for fees earned. So drawing is going to stay 0. Now fees earned has a balance of $7,500, and everything else is going to stay the same. Okay. Now let's look at E. Net Solutions paid the following expenses during the month: wages $2,125, rent $800, utilities $450, and miscellaneous $275. Okay, so that means we spent cash of, let's do this, negative equals sum of negative 2125 and negative 800, negative 450, and negative 275. So the total amount that we're going to deduct from cash is $36.50. So our new balance would be our old balance minus the amount that we spent on expenses. Now we have to record these expenses, and what we can do is, we know that they're being subtracted from owner's equity, but let's just put them in as minus so that we know. So wages would be $21.25, and rent is $800, and supplies expense, let's see, not yet, utilities and miscellaneous, $275. So now we're going to bring all these numbers down and bring our new balances down. Okay, so now we have all the new balances. I brought all of these balances down, and now the expenses have a balance in them of the amount shown here. So now let's look at transaction F. Net solution pay creditors on account. So they're paying some of the amount that they owe on the accounts payable. So what's going to happen is cash is going to go down, and accounts payable, think about it, you're paying on your credit card bill. Pretend that it's your credit card bill. If you're paying on it, you expect the balance that you owe to go down. So now let's calculate the new balance of cash and the new balance of accounts payable. Now notice that the only thing that changed on both sides was that an asset decreased by $950, and on the opposite side a liability decreased by $950. So the accounting equation is still in balance. Okay, for G, Chris Clark determined cost of supplies on hand was $550. What that means is, instead of every time we use a supply, we make a journal entry, we just wait to the end of the period and figure out how much is left, and that will tell us how much we use. So we had $1,350, we've used $550, we have on hand $550. So we're working backwards here. That means we've used $800 of supplies. So we need to record $800 in supplies expense, which is a decrease to owner's equity. So now I deleted some of the cells so we could just calculate the balance across. And for the last one, he withdrew $2,000 for personal use, so cash is going down. And also the withdrawals would affect equity as a negative, so that would be a negative $2,000 to equity. And then we will get our, and we will copy all of our balances down. And then we will check to see that the sum of the left side is the same as the sum of the right side. And it is, so it is in balance. And the next video I'm going to do is going to show you how to use these balances to prepare the financial statements.